Contributing to your RRSP may not be as straightforward as you think, and not doing enough research could cost you hundreds or even thousands of dollars. Sure, every year you get a certain amount of contribution room based on your income. You transfer some funds from your savings to your RRSP and get a tax deduction on your tax return, and all is good, right? Well, not really. Simply contributing to an RRSP just because you have the contribution room and claiming a tax deduction immediately may not always be the best idea. In this video, I'll discuss 4 things you may not know about RRSP contributions that could change your decision. But remember, nothing in this video is financial advice. Please consult a financial advisor before making any decision. Number 1, you could defer your RRSP tax deduction. You don't have to claim the tax deduction the same year you contribute to the RRSP. People tend to claim it in the same year in order to receive a tax deduction right away. But you could defer the tax deduction if you think you'll be in a higher income bracket in the near future, and this could increase your tax refund. For example, someone with a $50,000 taxable income in Ontario contributing $5,000 into their RRSP will get a $1,157 tax savings. But if the same person contributing $5,000 when their taxable income is at $60,000, the tax savings will be at $1,483. And if the person reaches $100,000 in taxable income, the tax savings will go up even higher to $1,860 for a $5,000 contribution. So if you know you'll be in a higher income bracket in the near future, you can always contribute to your RRSP, but just don't claim the deduction right away. That way, you can start growing your money tax-free while being able to get a higher tax savings down the road when your income increases. Number 2, you can contribute money to a spousal RRSP up to your annual personal contribution limit and claim the tax deduction yourself. This could be a good idea if your income is a lot higher than your partner's. By contributing to a spousal RRSP, the person with the higher income could receive a larger tax deduction if they are in a higher tax bracket. Now, since the RRSP contribution room is based on income, the higher earning spouse will have a larger RRSP account than the lower earning spouse if they just contribute to their own account and made similar investments. So at retirement, when the couple starts to withdraw from their RRSP, the higher earning spouse will have to withdraw more funds each year, thus potentially ending up in a higher tax bracket than the lower earning spouse. However, by contributing money to a spousal RRSP for the lower earning spouse, the money is split more evenly between the two accounts. As a result, when the couple retires and starts to withdraw from their RRSP, their retirement income will be similar, and the higher earning spouse could end up in a lower tax bracket and therefore save on taxes. Number 3, you can withdraw money from your RRSP tax-free for certain purposes. Normally, once you contribute to your RRSP, that money can't be withdrawn tax-free until you are at least 55, but there are a few exceptions. First, you can withdraw up to $35,000 from your RRSP tax-free to purchase your first home, but the amount must be repaid within 15 years. Repayment starts 2 years after you withdraw the funds, and there will be an annual minimum amount that must be repaid. You can also withdraw up to $10,000 per year up to a lifetime maximum of $20,000 to pay for your full-time education or training for you or your spouse. This amount also needs to be repaid with required payments starting 5 years after withdrawing the money, and it must be fully repaid by the 10th year. If you do decide to withdraw money for any other reasons, there will be a withholding tax of up to 30% depending on the amount you take out. Plus, the amount will be counted towards your taxable income for that year. So if your marginal tax rate is higher than the withholding tax rate, you have to pay additional taxes on the money you take out. Number 4, you could contribute stocks, GICs, mutual funds, or bonds into your RRSP, not just cash. This could be useful if you're low on cash but want to contribute to your RRSP. Your contribution amount will be based on the fair market value of the asset on the day you contribute to your RRSP. However, when these assets are transferred, they are deemed to have been sold at fair market value, triggering any capital gains resulting in taxes. And you won't be able to claim any capital losses if the investment is at a loss. So if you're thinking of transferring an asset that's at a loss, it's probably more worthwhile to sell the asset for cash, claim the capital loss, and then transfer the cash into your RRSP. But make sure you don't buy the same asset back within 30 days, else the superficial loss will trigger and you won't be able to claim the capital loss. In short, the superficial loss is a rule that doesn't allow you to claim a capital loss if you repurchase the same asset within 30 days of selling it. And there you have it, 4 things you may not have known about RRSP contributions. If you enjoyed the video, please consider hitting that like button and subscribe for more videos like this. And with that, I'll see you next time on Finance Briefs.